before we broke for lunch, we asked if Marcel and Ashby could stick around for maybe potentially one or two questions from the commissioners that they didn't have a chance to develop and maybe thought about a little bit over break. So, Mr. Vice Chairman.
Thank you. Dr. Monk,
Yes.
a quick question which
Sure.
shouldn't stump you because I've asked it twice today.
Oh, yeah.
Is carried interest an expense?
Yeah, so I have strong views. To give a balanced perspective, I'd say there's a lot of confusion around this topic. This is a confusion in part because we see the gap not really giving us clarity. But I think when it comes to the plans not reporting carried interest as a fee or expense and calling it a profit share, I wouldn't say that's conspiracy. I say that's confusion. I think if you on this topic, I'd have to kind of 2 points to make. One, carried interest in the public realm is thought of as private equity and hedge funds. And we think of the hedge funds of having a loophole of using the private equity carried interest. But when it's reported in the media talk about carried interest as hedge funds and private equity. In the PCER's reporting, they report the hedge fund carry, the absolute return carry, but they don't report the private equity carry. So I think that creates a lot of confusion as to why you would be purporting one form of carried interest, the hedge fund carried interest, which uses the same tax rule as the private equity carried interest, and not the other. So in like the court of public opinion, that's confusing. The second thing is we heard about this being profit share and an alignment of interests. Look, the example was given, we make $4, the GP gets $1. That's not a complete context-rich scenario. $4 gets earned by the plan, $1 gets earned by the GP, and there are base fees. That's on the upside. On the downside, if you lose the $4, the GP loses $0 and makes the base fee. So this is not about alignment. This is not a joint venture in the traditional sense of the word where there's commensurate gains and losses on both sides of the trade. And frankly, most of the consultants in private equity would tell you that this should be counted among the performance fees that you are calculating. The idea that it's a profit share, to me, is based purely on confusion. And we just need to resolve that confusion. It should be reported as a performance fee.
Commissioner Bloom? I have no questions. Commissioner Torbert? Commissioner Gallagher?
Just a continuation of that conversation. I'm sorry, I felt my eyebrows kind of pivoting inwards there because I was a little confused about the mathematics there because that $4 never got earned. So if you lose money on it, there isn't a gain to lose, right? So if the underlying asset doesn't produce,
in a partnership, a true partnership, there's a loss share as well as a profit share.
is there?
Yeah.
Okay, that's news to me because. Oh, well, actually, I do understand that. I understand the liquidation process. But what I don't understand is when we talk about the profit share not being a fee or not, just kind of waffling about that, and that it's indicative of how it's reported. Private equity does get reported in our CAFR. It's all included into a line item. It's just not broken out the way
Absolute return is.
The way that analysts like yourself would like to see it. We're getting there. We're developing that, right, over time, but there is no standards for that right now. As soon as there are standards in every state and every system starts complying with that, then you'll have that apples to apples comparisons between systems. Is that not correct?
I think I'd love apples to apples. In the absence of apples to apples, I would refer to how the IRS treats carried interest, and they treat private equity carried interest the same as hedge fund carried interest.
I'm still confused. Why hasn't GASB recognized what you recognize?
I'm not on GASB. I don't know. Marcel, did you have a view on whether or not carried interest is a fee?
So yes, I do have a view. I mean, carried interest in everything I've experienced is a form of a performance fee, and therefore it's a fee. So I'm of the clear opinion that carried interest is a fee.
Okay, great. Thank you again. Thank you so much for traveling a great distance, your expertise, and your continued assistance if we develop more questions coming down the stretch.
It's been an honor. Thank you.
Okay, our next testifier, Steve Nesbitt. Thank you so much, and thank you for accommodating us, getting behind schedule a little bit. Mr. Nesbitt is the Chief Executive Officer of Cliffwater LLC and oversees all investment research. I apologize. He oversees all investment research as the firm's chief investment officer as well. Cliffwater assists globally in the allocations of alternative investments. He has been with Cliffwater and actually started the firm in 2004. He was a senior managing director at Wilshire Associates, started his career at Wells Fargo Investment Advisors, and he was an early pioneer in index funds. His articles have been published in Financial Analyst Journal, the Journal of Portfolio Management, and the Journal of Applied Corporate Finance. We appreciate you being here today, Mr. Nesbitt. Thank you very much.
Well, thank you, Mr. Chairman, Mr. Vice Chairman, Commissioners. Thank you for having me today. Really appreciate it. I was asked to come to share my thoughts on issues of performance, transparency, and fees in the context of a state pension system. Closer? Yep. Okay, got it. I am here as an experienced institutional investment advisor, having worked with literally hundreds of public pension systems over the last 40 years. I have advised some of the largest U.S. state and federal pensions through my career. Okay, I've advised, given advice to, and as a consultant to CalPERS, CalSTRS, Connecticut Retirement System, DC Retirement System, Federal Retirement Thrift, Iowa PERS, Maine PERS, Massachusetts PRIM, Nebraska Defined Benefit Plan, New Mexico, Ohio PERS and STRS, Ohio Police and Fire, Oregon PERS, Pension Benefit Guaranty Corporation, Pennsylvania STRS and Pennsylvania PSERS, New Jersey, Rhode Island, Texas County and District Retirement System, State of Virginia, and Wisconsin SWIB. You can see that my credentials come really from the School of Hard Knocks. Okay? As an investment consultant, I have introduced and helped guide the use of both low-cost index funds and higher-cost private equity, seeing an important role for both. I've been intimately involved in virtually all aspects of pension investing as an advisor to both pension boards and staffs. My objective in the next 15 to 20 minutes is to share what insight I have into these issues with the Commission, okay? Providing perhaps a different perspective from several of the outsiders you have already heard from. Let me start with slide 1, okay, which I call the inconvenient truth in state pensions. You have already heard this narrative in prior meetings. Okay? Actuarial rates have been too high for too long compared to the returns pensions earned. The high actuarial rates cause contributions to be too low, eroding pension funding rates from near unity, or 100% in 2000, to roughly 70% today. Justifiably, all stakeholders in public pensions understand that this is a problem and want to fix it. I understand that one important Commission task is reviewing the state's investment strategies. No investment strategy is more important than asset allocation, adopted as policy by individual pension boards. Studies show that the choice and weighting to individual asset classes have the greatest impact on long-term pension return and risk. So the first question is whether the problem is with the investment strategy or the actuarial rate, or both, okay? Are pension boards making asset allocation decisions that offer the best chance of achieving pension security or not? You have already heard testimony on long-term asset allocation trends, which I won't repeat here. Instead, I want to impress on you that public pension systems cluster in almost all their investment decisions, and no more so than an asset allocation, covered in slide 2. Okay. Foremost is the role of the prudent person in fiduciary law. Investment decisions by board members are heavily influenced by what other pensions are doing, a proxy for prudent person. And in the small community of public pensions, everybody knows what everybody else is doing. This is reinforced by the handful of investment consultants that guide asset allocation decision-making using mostly the same models and inputs. Importantly, this all leads to similar asset allocation policies groomed by the collective wisdom of boards and investment professionals and producing returns that the financial markets will allow them to earn, not what actuaries assume they will achieve. As fiduciaries, boards are continually balancing the pull of high actuarial rates against the push of higher risk that achieving these high rates would entail. Most pensions end up roughly in the same place, as slide 3 shows. Okay. Where return and risk for state pensions cluster tightly between a commonly used low-risk bond index and a higher-risk stock index. State pensions fail in asset allocation when they give up too soon on their existing asset mix, for example, moving from lower to higher risk strategies near the top of the market, or moving from higher to lower risk strategies after a market downturn, and particularly that latter case. Sticking with the existing asset allocation strategy has proven as important to long-term performance as which strategy you choose. Let me also add that statistically, state pension asset allocation has been independent of funding ratio. This means that state pensions generally ignore or act as if they ignore funding ratios in setting asset allocation. Anecdotally, that has also been my experience and is not necessarily a bad thing. Boards have generally viewed pension funding as an actuarial issue, not an investment issue, seeing themselves as setting prudent investment policies with expected returns that actuaries should then use to set funding amounts. An unfortunate post-global financial crisis perversion has been to pressure boards to change investment policies to be consistent with high actuarial rates and their low funding schedules, rather than fiduciary standards. In summary, my opinion is that the health of state pension systems has not been compromised by current or past asset allocation policies. Staying on the topic of investment strategy is the question of active versus passive management. Let me first say that public pension systems were some of the earliest and largest investors in index funds because of their low fees, good performance, and ability to get monies invested and divested quickly. None of that has changed, and index funds now represent close to 70% of U.S. equity allocations and 20% of total state pension allocations. The attraction of index funds, though, is not all consuming. Okay? First, there are asset classes where indexing is not possible, like private equity and private real estate. Second, there is a concern with trade execution and price dislocation for index funds that track securities that are not traded on exchanges, such as high-yield bonds and leveraged loans. Third, there are some asset classes that are viewed as price inefficient, where investors believe active management can add value net of higher fees. These include small cap stocks, high yield bonds, and non-US stocks. Most state funds use a combination of active and passive management for these asset classes, with very few 100% active or 100% passive. Slides 4 and 5 illustrate some of the thinking behind active and passive investing. Both slides report 10-year performance for state pensions by asset class. Slide 5 provides asset class returns for individual state pension systems, while slide 6 consolidates asset class performance into a single asset class average. As shown, also shown are the most common asset class benchmarks, which can be viewed as proxies for passive management. U.S. equity allocations generally trail index funds. U.S. equity returns generally trail index funds, represented by the Russell 3000 index, suggesting that perhaps more or all of that asset class should be indexed. However, for fixed income and non-U.S. equity, state pension returns have generally outperformed index funds. State pension boards regularly weigh past performance and fees in deciding how much of every asset class to allocate to index funds. Key to a well-functioning of a market system is a reallocation of capital from bad-performing companies to good-performing companies. This function was largely broken in the 1970s as companies grew to become large, underperforming conglomerates without outside forces that could change market behavior, to the corporate governance issue mentioned earlier. Terms like entrenched management, enriched management, conglomerate discount came to unhappily describe corporate America. At the same time, corporate pensions dominated the institutional landscape, and their proxy policies were strictly to vote with management and not to rock the boat. This capital dysfunction was corrected when large state pensions began using private equity, proxy voting, and high-yield bonds to dislodge bad management and capital from poor-performing companies. Private equity and high-yield bonds not only directly benefited state pensions through higher returns, but also indirectly benefited index funds through merger and acquisition premiums, a form of economic externality that bequeaths a part of the wealth creation of private equity to index investors. Slide 6 reports net of fee performance for private equity for individual state pensions and a composite return for 16 years ending fiscal 2017. Without exception, state pension private equity returns, net of fees, all fees, exceeded an equivalent public equity return, with the average private equity return exceeding 10.7%, compared to 6.6% for the public equity markets. The difference of 3.1% per year, if repeated over the next 10 years, would produce a cumulative 87% in additional return compared to the index fund alternative. Considering past performance, it is surprising that the average state pension allocation to private equity is less than 10% of total assets. Previous testimony has suggested that private equity has lost its performance edge versus public equity. And it is true that post-global financial crisis, state pension private equity returns have exceeded public equities by a smaller 1% compared to the 3% long-term average. However, drawing forward-looking conclusions from this data is premature. Historical return patterns show that most of the outperformance in private equity occurs when public markets turn bearish because private equity valuations get a chance to catch up get a chance to catch up to public valuations. And two, the value-driven strategies of most private equity is most effective during stock market downturns. If I may briefly go back to the subject of asset allocation and speak to the issue of private equity and liquidity management, which has been generally overlooked in asset allocation. Trustees learned from the global financial crisis that asset allocation targets to private equity and private assets more generally need to take account of cash flow needs of the pension system and the potential for large variances in actual versus target allocations during downturns. Prior to the global financial crisis, many endowments, including large endowments like Princeton and Stanford, had outsized allocations and unfunded commitments to private assets, well exceeding 50% of their total assets. The crisis forced these and other endowments into potential distressed sales of their illiquid assets and unfunded commitments to meet then current spending needs. Fortunately, distressed sales were largely averted as capital markets rebounded and private asset managers delayed calling uncommitted capital. But the experience was a lesson learned, and today state pensions routinely incorporate liquidity management when stress testing their asset allocation policies. My own experience working with pensions and endowments is that allocations to private assets above 40% of total assets requires a detailed liquidity plan as part of overall asset allocation. Currently, the average allocation to private assets among state pensions equals 25%, well below that 40% threshold. Let's turn now to manager fees, because despite strong historical returns produced by private equity, it is also where state pensions spend the most in fees. One of the challenges in understanding private equity fees is that they can't be expressed as a fixed percent of assets. In addition, there are several fee components, and each component can vary depending upon performance and time. Fee components and levels are spelled out in the private equity partnership agreement. These are negotiated between managers and investors before the partnership is activated. So again, there is an active negotiation of fees. It happens when the partnership is originated. Large state pensions have historically played an active role in negotiating private equity partnership fees and terms, and are not simply price takers. Slide 7 provides total fee estimates for a typical private equity partnership for different levels of gross of fee partnership return. Note on the right-hand side of slide 7 the fee components and fee rates for a typical partnership. Collectively, these fee components and rates produce different fees as a percent of invested assets, the common measure of expressing fee rates, for different levels of gross partnership return. There's simply not one number. This uncertainty in combined private equity fee rates is frustrating when trying to answer the simple question, what am I paying for private equity? But as slide 7 shows, paying more in combined fees is probably a good thing because your net of fee performance is better. Our fee analysis using simulation to capture different possible return outcomes yields a combined private equity fee equal to 3.73% of invested assets, which represents approximately 25% of gross profits. How might investment professionals pass judgment on these fees? Well, the 25% of profits would likely seem very reasonable to investors in private assets. On the other hand, the 3.73% combined fee as a percent of invested assets might strike some investors accustomed to more traditional fee structures as extraordinary. Fee fairness is difficult to assess, but in their allocations to private equity, these fees are aggressively negotiated by state pensions against the backdrop of performance expectations and competitive pressures to access top-performing funds. My intent is to impress on the Commission that by no means is there an attitude of acceptance by state pensions when it comes to fees. In addition to pressing for best practices when it comes to partnership fees, state pensions are aggressively moving in 2 additional directions to lower fees. The first is co-investments, which allows state pensions to potentially invest directly in the same deals as the manager puts in their fund, but at a much lower or no fee. The second is called strategic partnerships. These are bespoke agreements between state pension and a highly valued manager, where state pension commits significant long-term capital to the manager across multiple years and strategies in return for lower management fees and the netting of performance fees. These are important tools that state pensions can use to significantly reduce overall private equity. And also these are tools that they originated. In my final remarks, I would like to first compliment all the presenters that preceded me. Their analysis, opinions, recommendations deserve serious contention. But I do take exception to a narrative that a couple presenters put forward, and that is the claim that state pension staff are hiding fees from the public for fear of losing their jobs. I can tell you from personal experience over many years that nothing is further from the truth. I have found staff across pension systems to be well-qualified, hardworking, ethical, and thinking first of the beneficiaries that the assets support. In fact, today, one of the most serious issues facing state pensions is keeping staff, particularly in the nation's state capitals, where professional opportunities in public policy far outweigh the opportunities in investment policy. Most likely, outsider distrust of pension staff comes from the lack of understanding that transparency itself is negotiated as part of the legal agreements underlying private equity and other private investments. Part of the agreed upon terms of these investments is confidentiality on the part of the investor, subject to legal redress. Pension staffs are not turning over data to outside parties because they are abiding by these agreements, not because they are afraid of their jobs. Yes, state pensions could change these agreements and require transparency by their private equity managers as a condition of investment. Perhaps public policy overrides investment policy in this instance. But make no mistake, such action will likely result in lower returns of some unknown magnitude, okay, from adverse selection, particularly in today's favorable fundraising environment. With that, I conclude my testimony. Thank you, Mr. Chairman, for the opportunity to share my thoughts, and I would welcome any questions you might have. Thank you.
Mr. Nesbitt, thank you so much for traveling here. Thank you for your work and testimony and expertise. And I just have one or two brief questions. You mentioned at the beginning of your testimony, with your long resume, you've worked with so many different pension organizations, but you've also done some work with SERS and PSERS. Can you tell us what work you've done to the systems with the systems in Pennsylvania?
Yeah, so it's dated now. So one of my first clients was Pennsylvania State Employees Retirement System, and I think I was 28 at the time. But this was during the 80s, and we did some great things. We introduced performance fees. So the first performance fee for a long-only strategy, a traditional long-only strategy, was done by Pennsylvania State Employees Retirement System. We also introduced index funds for the first time to that state system, and actually created a Pennsylvania index fund. At the time, if you remember, the governor, Thornburg, was very interested in in-state investing, and so we created a Pennsylvania index fund, which did pretty well. So it was cost savings, fee reduction was a headline event back in the 1980s, and I thought we did good work there. A previous speaker talked about brokerage, which basically here in the U.S. we know it as soft dollars, and so soft dollars were very high. And basically, we insisted on eliminating soft dollars and monitoring brokerage costs and transaction costs at that time. It was during the 1990s I worked with Pennsylvania School Employees Retirement System. I built an office. They wanted local representatives, so I built an office in Pittsburgh at my prior firm, and took the puddle hopper from Pittsburgh here. But it was there that we introduced private equity, which became a very good performing asset class for them, and did other good work for them, introduced index funds, et cetera. So I'm sorry for that long-winded answer.
No, great.
It's kind of memory lane.
Yeah, so it's important for us to know your past work and commitment continued commitment to the Commonwealth of Pennsylvania. So I really thank you. So some of the people that you work with, or the organizations that you worked with, I'll get back to the transparency question and this balancing act between confidentiality and transparency. They don't work congruently. So some of the other systems that you work with have been leaders in transparency, and I think you mentioned Rhode Island. I think that they've come back and said something that's maybe contrary to your testimony, saying that they haven't seen that being more transparent has caused them to erode their ability to enter into investment contracts. Can you comment on that a little bit, and particularly how you see Pennsylvania with the opportunity to become more transparent, or where do you think we're at right now?
Well, if I don't know who was here from Rhode Island, but if they said that, I agree with it. So, but I do know specific cases where GPs have said, we really don't want you given you policies of transparency, we don't want you as an investor. So, and different states make different judgments on that. The treasurer, very able treasurer in Rhode Island, has decided to be very, very transparent, and so that the board went along with them, and that's their decision.
So ILPA is kind of setting the standard now, trying to get on a national level, trying to get more people on board with a blueprint for transparency. Do you have any comments about their model and how that might assist other states in the endeavor that we're also working on?
We're a big supporter of ILPA. So, our hope is that basically all public pension systems adopt ILPA, and that all managers get on board in that type of disclosure. And so I think that's a very positive thing that's happening in the industry.
Great. Thank you again. Do you have any questions, Mr. Vice Chairman?
Thank you, Chairman. Thank you for being here, and thank you for your past work for Pennsylvania. You said that large state pensions have historically played an active role in negotiating prices and haven't just been price takers, which is encouraging to hear. So is it your belief that systems as large as ours can negotiate good prices?
Yes, but as a collective. So basically, basically it's the large systems that negotiate price with the GP, and so they're not individual negotiations. It's basically the GP and the large LPs know who's going into the fund, and basically they call each other and say, hey, what do you think about this? Do you agree with that? And basically they put pressure collectively on the GP to change terms or to change fees. So it's basically...
So larger and more is better than smaller and less?
Well, there are...
in most things.
Yeah, at the margin, big is beautiful. But I will say there are some more medium-sized, really well-respected state pensions that carry as big a stick as the larger ones.
Right. And a question on liquidity, which I thought was an important point you were making. So you said that in the great financial crisis, some funds found themselves with illiquid investments, including their allocations and unfunded commitments of greater than 50%. You said, I thought that you thought 40% was where yellow lights flash. Is that in your practice, your view that the appropriate yardstick is when allocations and unfunded commitments are more than 40%, there needs to be a very careful analysis?
But it all depends on individual circumstance. Generally, boards are willing to tolerate a plus or minus 10% at the outside vis-a-vis their target allocations. If you have more than 40% in private equity and you stress test that allocation amount in 2008, 2009, that 40% becomes basically something close to 60%, between 55 and 60%. And that causes a variation from policy that's really outside the typical bounds.
And would that be the better funded the plan, the easier it is to tolerate, correct?
Well, no, no,
Liquidity issue.
that protocol, if you will, to stay within your asset allocation range is really, in the first order, it's independent of your liability. In the second order, if you have a large unfunded liability, generally you have more negative cash flow. You have more benefits going out than you have contributions come in, and that situation would suggest something more conservative.
Okay, thank you.
Commissioner Gallagher?
Thank you, Mr. Chair. And I think the treasurer just touched on my question is just, how does a fund that is 60% funded navigate as compared to a 90% funded plan in terms of the liquidity needs and cash flow negative? We've got a very mature, both of our plans are very mature. One's more than the other. The state employee system is much more mature. Given those contexts of demographics and presently the asset allocations that both systems deploy, which are different, and that brings about contrast that kind of elucidates a way to think about things differently. But can you layer in about, just relatively speaking, within the framework of the logic of your piece here, how is it a fund at a 60% must navigate on a moving forward basis relative to a 90% funded plan?
That's a very challenging question without one answer. So let me explain myself here. This is really the view, in my experience. I've had pension funds that were exceedingly low funded, that took the long-term view and stayed aggressive. And I've had those that were really underfunded and basically were worried about running out of money, and they became very conservative. So what's the difference in the vision of those two boards? It really has to do with how they view the sponsor of the pension system, in other words, the state. So one of my early clients was the state of Massachusetts, and this was 1985 when they first set up PRIM, when they took all the local pension systems and put them together and had one board, one policy. Their funded ratio was 25%. And if you think about the 80s in Massachusetts, it's like, gee, the logic would suggest, let's stay conservative because we may run out of money in the next 5 years. Okay, with a 5% spend rate, that was a possibility. Basically, they came to the opposite conclusion. That the governor, the legislature, all the stakeholders said, we're going to have a commitment to funding. Okay, we're going to have a 30-year funding schedule where we expect to pay for this unfunded liability, and we're all bought in on that. And so the pension board at that time, which had a diversity of stakeholders, said, okay, given that we have assurance in that obligation to provide state contributions, given that we have that assurance, we can go for the long term, and we can invest aggressively with the idea that we're going to lower the long-term cost of the pension system. So, same time, I've had pension systems that are currently at 40, 50% funded. That, I'm not so sure about my sponsor, my state, whether their commitment, either the legislature, or the governor, or whatever. I got to worry about running out of money. And so I'm going to, I see my duty as maximizing whatever money's left to provide for those shorter-term benefits. And so they adopt a more conservative policy. So I apologize, but there is no one answer. Yeah.
Commissioner Bloom?
Yeah, I just am reading this one piece of your testimony that I just wanted to clarify, and I'm sure you'll understand. You said that a couple of the presenters put forward there's a claim that state pension staff are hiding fees from the public for the fear of losing their jobs. I don't remember anybody actually using those kinds of words. There has been a debate. There's been a pretty healthy debate for the past 6 months, as long as the commission's been in, as to private equity and carried interest. And I don't think anybody has said people are hiding numbers or hiding. It's a matter of how they report the fees. I think everybody has tried to be accurate, and I think our staffs are, as you put it, qualified, hardworking, ethical, and thinking first of the pensioners, at least the ones that I've spoken to. I just wanted to clarify it because it looks a little bad when if we were listening to folks who were telling us that people might lose their jobs for hiding fees. I don't believe that's any of that's true. I just wanted to let you know.
I don't, thank you. Maybe those words are strong, but I heard it twice in testimony, listening to the audio and video. So I just wanted to make it clear to anybody else who was listening.
Okay, great. We thank you. We thank you once again for being here. We thank you for your past assistance to the state and your current assistance to the Commonwealth, and we would look forward to being in contact with you as we work to close out this document.
Thank you very much, Mr. Chairman.
Thank you. So we have passed the seventh inning stretch, and we're here, I think, with our final testimony of these hearings. And we've got a distinguished gentleman with us, Dr. Charles D. Ellis, extensive resume, graduate of Exeter and Yale College with an MBA from Harvard Business School, a PhD from New York University, has served on the Board of Trustees of Yale, Investment Committee, Stern School of Business at New York University, the Brown Foundation, and CalPERS. As I mentioned, his resume is extensive. We appreciate him being here. Here's what I think I know. He likes to be called Charlie. So with this resume, humility is one of his best characteristics, I think. And I think you hail from Boston. Is that? Charlie, you a Boston native? A Boston native of Boston?
Roxbury.
Okay.
Part of Boston as Boston would define it. It's fiercely independent as people living in Roxbury.
Okay, good. But that means that you appreciate the fact that the left fielder Benindetti last night made a terrific catch at the track and that he hung in there in the fifth inning. My daughter's living in Boston right now. That's her favorite player. And I know that that made you happy that the Red Sox won. So we're happy that you're here, and we're happy that you're happy because of that.
Well, I think
So
that's a very nice thing to say.
We look forward to your testimony. Thank you.
I think we all ought to recognize that it's late in the day, and I'm sure I won't be as articulate as I could have been earlier, and I'm sorry about imposing on you for more time.
We're happy you're here, and you are the cleanup batter. So
I was given complete freedom, which I'm going to take because for the first time in my life, I'm not accepting a fee for doing any work for anybody in the investment management world. And the reason I'm here is the demand that I have a very high regard for, has a very, very high regard for your treasurer. And we had a delightful conversation and realized if he's going to be working on the kinds of questions I think are really important, I would like to help with him. My deepest concern personally is that retirement security is in this country increasingly at risk, perhaps even a myth. And it shows up in a variety of different ways, but it does show up in the public pension sector. It shows up for sure in the private sector. And we as a nation can see that a nightmare is headed our way unless we start doing something about it. But since it's not an immediate crisis, most people are putting it off. I'll worry about that later. I'm at my age, I can't put things off for very long. So my focus and interest on that had me deeply attracted to coming and spending a little time. And I would love it if I could be truly helpful to you. I am going to rehearse or go over a decision you've already made and just urge you to keep on going until you've got it completed. And that is the movement to indexing and away from active management. If you go back to 1965, when I was first getting interested in investment management, active investing was the only way to go. But every factor that made that the only way to go then has been reversed 180 degrees, and it no longer applies. Let me just give you some of the characteristics, and they are, when you get down to it, truly profound. Back in 1965, trading on the New York Stock Exchange by professionals, and that's a guarded term, was a little bit under 10%. Let's call it 9%. The rest was done by individuals who averaged one trade every year or two. Half of their trades were in AT&T because it was the most widely known stock. They had no access to any research or information on companies at all, except a Standard & Poor's so-called tear sheet. It was a 5 by 7 inch double-sided, and it looked only at the past, had nothing in the way of forecasting or what you could expect. They had no reason to know what was going on, and they might have read Business Week or Forbes or one of the other business magazines, but they really relied on a retail stockbroker. They were not hard competition. The 9% that were quote-unquote professional were dominated by regional bank trust departments. You may remember back then, banks were limited to state lines or less. And so there were, in my hometown now of New Haven, there were 4 trust companies. And they bought laddered maturity bonds, and they bought blue chip stocks, and they met once a month at an investment committee and had an approved list. And it was not a tough group of competitors. Today, 99% of the trading, not 9, but 99% of trading every day is done by machines, driven by artificial intelligence, and by professionals. Half of the trading by professionals is done by the 50 largest, toughest traders. That is a very dangerous, aggressive, competitive environment. And all of us need to recognize that that is a really different world. Let's talk about some of the other things. Back in '65, Goldman Sachs had no analysts that served a public purpose. They had 12 analysts that served the partnership looking for small cap stocks. Today, Goldman Sachs and every other major firm in offices all around the world have about 600 industry analysts, company analysts, GNP analysts, monetary analysts, commodity analysts, and all kinds of other people trying to find bits and pieces they could be helpful to investors, the same terrifically aggressive professional group of investors, to earn some commission business for their activities. That is an unbelievable flood of information, and it's because of the internet. Everyone has 24-hour access to all of that information anytime they want it. The federal government has added to that Regulation FD through the SEC. It is required of any public company that gives any investor any useful information for investment purposes must make a diligent effort to get that same information simultaneously to all investors. So the secret sauce of active investing, which is to do more homework than the other people, get to know the company better than other people, get more data, do more careful analysis, that has been obliterated or commoditized, and everybody's got it. Mike Bloomberg was still in school. There are now 240,000 Bloomberg terminals all over the world. And if you look at how many people do you have to justify one of those terminals, it would confirm my best estimate that the number of people who are involved in active investing has gone from less than 5,000, most of whom would have been located on the Eastern Seaboard or in the United Kingdom, to comfortably over 1 million people, all of whom have had as the same objective: find a pricing error, find an imperfection, and take advantage of it. And as a consequence, the markets have become more and more and more and more impossible to beat on anything like a systematic basis. There are 2 ways you can approach a concept. One is to start with a theory, and the other is to start with the data. Einstein's famous for theory. So the theory of efficient markets has been around for quite a time. Darwin's get the data, the kinds of data that I've just been sharing with you, and there's half a dozen more specific elements that I'd be glad to share if you wished it, lead to the same conclusion. Bottom up, top down, it's not going to be a good place to take on the cost of operation. An active manager costs about 100 basis points a year in expenses that he incurs and trading imperfections. Add to that fees of maybe 50 basis points, so you got to pick up 150 basis points. in a market where the people that I think of as being most knowledgeable estimate total returns of 6 or 7% in equities, we're talking about 20, 25, or 30% better than the competition who have exactly the same information you have, exactly the same time you have, with just the same computing power you have. They're just on different floors in the elevator bank. And it doesn't make any sense for someone to say, I am going to pay the fees that are being charged, and I'm going to put up all the capital for a very unlikely rate of return. If you think mutual funds are a reasonable proxy of people who are trying hard, now we have data that in the last 10 years, 84% of mutual funds have failed to keep up with the benchmark they chose to beat, the benchmark they had freedom to choose how to organize to do it, this benchmark they are specializing in. That's a dreadful consequence. Has it been addressed and exposed and talked about a great deal? Certainly not. But it is a reality. And we said, well, what if you made it longer, 15 years? It goes up from 84% to 86. Said, well, how about other markets? In the United Kingdom, it's 87%. So the whole concept of active investing was right, but the world changed and changed and changed and changed. And just as the kind of clothing we wear on the weekend during the last couple of months is not the kind of clothing that we wear on a weekend in the next couple of months, the world has changed, and everybody should be recognizing. The fact that you have recognized it, I think is terrific, and I would urge you to go right on ahead and complete the task. So that's the main part of what I really wanted to say to you. There are several specific things that if you would tolerate, I'd like to make gratuitous suggestions for consideration in the future. What has happened in active equity management is candidly just the tip of the iceberg. The same thing has been reproduced in fixed income investment management for high grade or medium grade securities. It's going to be picked up and carried through to all the other types of investment because there is a huge money flow that is looking for higher rates of return. Some of it is sophisticated. Candidly, some of it is not sufficiently sophisticated or sufficiently aware of the difficulties to recognize how hard it's going to be to compete with all that other money that's coming in to compete for access to the very best investment managers. You probably know that in venture capital, if you're not in the top 10 by number, not 10%, top 10 managers, you are going to underperform the public market if you go into venture capital. Because the top 10 get all of the superior rates of return. It's not unlike that in private equity. The very best firms that do the best work have already got a superb clientele that they are serving on a regular basis, and they are not competing for or looking for new money. By the time you get to the second quartile that would be open for business and interested in adding more money, you're running the risk of drifting down towards normal public market rates of return. By the time you get below the median, you're really in serious difficulty. And I think all of us ought to recognize how difficult it is now, and it's going to get more and more and more difficult because the amount of money is piling in at a terrific rate. If I could make a suggestion, this commission would be wise to stay focused on the passive or indexing versus active. Complete that task, illustrate how wise you have been, and go back with a recommendation for further study by other groups or yourselves of a blue chip blue ribbon commission to study other questions of real moment. But I would urge you, don't try to factor them in with the kind of a report that you have been mandated to achieve, as I understand it, and which you're very close to having terrific documentation for and a very strong case to be made. Let me pick up on some of the things that might be of caution. Could we get a really great blue ribbon commission? I think the answer is yes. I'm from Connecticut. I do not know Pennsylvania well, but if you took Pennsylvania and just said the 10 largest endowments, could you find really talented people? I think so. If you took the 20 largest investment managers, could you find substantial numbers of people? I know so. I spent for 10 years, I was a director of Vanguard, They are filled with extraordinarily talented, public servant-oriented, caring Boy Scout types of people. You've got at least 100 corporations that got for their pension staff very capable people. And then you have all the people that were retired in the last 5 or 10 years who are still very knowledgeable about what the issues are, very well connected, and have a substantial amount of experience. It would be easy, in my view, for this extraordinary Commonwealth to put together a first-rate group of people to do serious study of other questions that I would urge you, as a particular commission, not to get involved. The returns in public equity are going down because the volume of money that is chasing after public equity will be taken in by firms and will therefore be competitive in the market for opportunities to buy things that could be taken private. The competition will raise the prices, and when the price level going in has been raised, the rate of return at the end, the price level at the end does not get changed, but the rate of return in the space in between does get changed, and the rate of return is clearly going down. It will go down for the top firms, but it'll go down more for the next tier of firms and go down even more for the next tier of firms. So it would be a very, very difficult period. If I could be just blunt spoken, when somebody says fee and carried interest are different, I agree with that mechanically, legally, and so on. But everybody I know in Wall Street and everybody I know in investment outside of Wall Street is absolutely clear they're part of the same thing. That's what we get paid. And the cost and risk that's absorbed by the clients is worth paying close attention to. You put up 100% of the money, you take 100% of the risk, you have 100% of the liquidity, and then the managers claim a 20% carried interest. If that isn't part of their compensation or the reason they're in business, it would be news to me, and candidly, it would be news to them. You heard twice today or 3 times today that steady contributions into the system would be very, very valuable. Yes, full stop. It would be really worthwhile having careful study done of the actuarial assumption as to rates of return. They do appear to me to be seriously high. And I recognize that if you look back over the last 30 years, there have been some truly wonderful times in rates of return. Almost no one who is active today was around when Paul Volcker drove interest rates on 10-year treasuries to 13% in order to break the back of inflation. Wonderful public service. Footnote, during that entire period, with all the abuse he was taking in public and from politicians, he was every weekend going back to New York to take care of his infirm wife and cook her meals for Saturday and Sunday and leave in the refrigerator Monday, Tuesday, Wednesday, Thursday, and Friday meals. Wonderful human being, devoted to the American interest, and did this nation a world of good. But the market went down in that period by more than it went down in 1929, if you include inflation. We really got hurt. And that drove the market to such a low level that anything coming back should have recognized where it came from. Sure, the returns were high, but they were nominal returns. If you recalibrated and took 1968 as your base, you wouldn't have seen those returns as being all that great. Be careful how people take old data and apply it to a new situation. I have difficulty understanding why you have 2 different plans from the point of view of investing and what I would call the back office operations. I can understand why you would have 2 different plans in terms of representation of the teachers and representation of all other employees. But why they ought to be operationally separated doesn't sound like anything that would be chosen by a rational observer. The best managers are capacity constrained in private equity. If you have, your organization has managers who are not capacity constrained, they are not the best managers. because the best managers attract the best clients, and they seek out the best clients, and they have already cleared the table before the rest of us get there. So if you accept that there's capacity constraint, it's only with those who are earning the right to be capacity constrained through the excellence of their work. And I'd be very, very careful of the way the terminology gets moved around. I would urge you to consider the possibility of developing a consortium of the major state funds to deal together on resetting the terms. Doing it one at a time can't work because you'd be played off against each other. But if you had a consortium, you might very well be able to make a real change. And there's plenty of room for real change. I'd like to just stop with an invitation for any questions, particularly tough questions, and a thank you. I've had a wonderful experience being able to come and to sit in on the testimony that you heard before. I've learned a lot. I haven't been pleased by some of the things that I've learned. And I've had the privilege of getting to know some of the members on this commission, and I've been deeply impressed by the caliber of their commitment and the quality of their intention to serve the Commonwealth. And it makes it, from my point of view, worth the trip. And I can't tell you how much I appreciate it. Thanks.
Well, Mr. Ellis, Dr. Ellis, we're honored that you're here. Again, we appreciate it. So you heard some conversation today about governance, and you've dealt with many different pension systems, and you're taking a look at a system right here that has got two boards that are not the same, but in some essence they are. They are political appointees from different stakeholder groups. What's your perspective on how an organization, a pension organization, can be most effectively directed by a board that is capable and lacks influence to the extent that they can make the difficult decisions to win a loser's game?
For the representation of the beneficiaries and for representation of the Commonwealth, I think you've got a fine board because they are representative and hopefully they're well chosen. For investment management, a highly specialized, rapidly changing, increasingly competitive, and increasingly difficult field, to ask people who are not deeply immersed, virtually full-time in that work, is unfair to them and unfair to the people who will be dependent upon the results of their work. You should be developing an independent or a separate group who are directly responsible for the investment management. Yale University's got a wonderful group of trustees. They've served with distinction for years. They have wonderful characteristics. But we very deliberately choose a small group of people to do the investment management, all of whom are investment experts. Otherwise, it can't be done.
Thank you. Mr. Vice Chairman, questions?
Thank you. And thank you so much for being here and for doing a great public service to a state that's not your own. But I'm not sure this is in my charter as treasurer, but I think I hereby declare you an honorary Pennsylvanian. So
I'd be honored to accept if it's in your jurisdiction.
Can I get away with that? I'm asking the legislator. Yeah, why? Okay.
You know, if you go outside and come in again, this truly beautiful building has got all kinds of very nice decorations. One of them is a citation from William Penn, who's talking about what he really had in mind for Pennsylvania, that it would set an example for others. And candidly, that's why I'm here, and that's why I am so pleased that I'm here, because you are setting an example for all those others who haven't done what you've done, which is identify the need for some specific service on indexing versus active. Nice home run. And then I hope that you will find a way to get the legislature, the governor, or both to recognize there's a real opportunity to do many other component parts of the total complexity of the system of investment management.
Well, if we succeed in that, it will be in part due to your doing us the courtesy and the service of coming. So thank you. On indexing, we do hear from time to time two things. One, you hear the assertion that, Well, that makes sense for large cap stocks, large cap U.S. stocks, but for other places where there are, there are less efficient markets, it doesn't make so much sense. Even though my reading, at least of the SPIVA data, is that those same numbers obtain. And I wanted to ask you if for your views on that, or why you think that there's still this persistent view that in things other than large cap U.S., active management makes sense. The second thing we sometimes hear is, going to your top down, bottom up, people will say, well, the theory of it is plausible, but my managers have outperformed. We've had 5 years of outperformance, so shouldn't we keep sticking with that? If you can comment on those two things, that'd be great.
Sure. I probably had more opportunity to study investment managers than anyone else in the world. I spent 30 years as the managing partner of Greenwich Associates, and our principal line of work that I was involved with was investment managers. And we had clients in every major market around the world. And we worked with the investment managers in every one of those markets, usually the top 3 or 4 people in the firm, and usually the top 4 or 5 managers in each market. Usually the top 10 or a dozen managers in each market, and the top 4 or 5 people within each of those managers. And one of the things that is a dreadful reality is that they come and they go. And I first recognized that after we'd been doing this kind of work for 10 years. Isn't it astonishing? Some of the people who are at the top are no longer included in the top 10, no longer included in the top 20. And then I started paying attention to that. And as the years went by, it got worse and worse and worse, because it's a hugely competitive business. And the data that people were making decisions on is statistically interesting, but it is not statistically valid because it's a way too complex process of investment management. And comparative, it makes it a doubly way too complex process. And small differences do show up and cause people to make major moves, clients to make major moves, which is, over time, notoriously a mistake. Best estimate that I have is that the error rate on changing managers for major corporate and public funds runs somewhere between 100 and 150 basis points per year on average. That's a serious penalty. Do people recognize it? No, because the decision makers change and change and change. We don't examine the study data of what's happened to us in the past. It's only when SPIVA came in with the data on the mutual funds that anybody had any recognition. My Lord, look at what an enormous failure rate is taking place. And these are wonderfully talented, hugely carefully chosen people who are given mandates that are really responsible, not just to their clients, but to the managers of the firm. And still, you've got over 80% failing in such a short period of time. And that confirms the experience that I had. So, and that was not in any other country where it really changed. It's a dreadful irony that all the firms will recognize that they've gotten better. This is a major point that I'd like to have made earlier. Every firm that I talk to knows that they're better. They've got better computers. They've got more carefully trained staff. They've got much better models on their computers. They learned a lot, and they are raring to go because they know they're better than they were 10 years ago. What they don't recognize, but only an outsider might be able to recognize, is that they're actually getting closer and closer and closer and closer to being equal in their capabilities, because they all have Bloomberg, they all have the internet, they all have SEC regulation, fair disclosure. They all have 600 analysts at every major securities firm pumping stuff into them all the time. They all have everything you could dream of having. And they're therefore more and more and more equal. And when they get more and more equal, it's harder for them to beat the other guys enough to cover the costs or the fees and get back to even again. So they fall short. But it's a real short. And it's not going to change. People ask me, oh, Charlie, indexing has been doing so well. I'm sure it can't continue to do that well. There's going to come a time when it's time to go back into active investing. Candidly, I look at all the different ways people have come up with it, and they all sound like prune juice to me, but there's one that I think is sure. If we could get the 1 million people who are actively involved in active investing right now to drop down to 50,000, 25,000, gee, wouldn't it be great if it went down to 10,000? And we're talking about almost everybody saying, the hell with it. I'm giving up on investment management. I know it's the highest paid line of work in the world. I know it's the most fun line of work in the world. I know it's the most traveling and other activities that are just terrific. I don't want to do that anymore. I want to go be a middle manager at some middle-sized industrial company. And I'm going to have to learn a lot in order to be able to do that, but I'm going to get rid of all this other. That's not going to happen. We graduate enough people every year from business schools all over the country and around the world to fill up any empty spaces that are created. Until you can get a large number of people who say, it's spinach and I say the hell with it, or something equivalent to that, and quit the business, you're going to have too many people with too much talent, with too much information to be able to say, I can go out there and beat them. It ain't going to happen.
Thank you. Commissioner Gallagher?
Dr. Ellis, I learned.
Probably will do
I hear that, but you are of an exalted status, so I appreciate you being here and sharing your insights so that we can make informed decisions that will be generational and in nature. My question I'm going to pose to you that I've posed to a former CIO of a very large Canadian system who is now working at a very large private equity firm in the U.S. Same question. I said to him, what's the difference between your organization and a high school student with a computer in California? And he recognized the uniformity of information that's available now to a lot of people, to your point about, how information is getting flat. And his response was that, fair question, I'll give you one example. His was that his organization has a fleet of drones, and they are able to fly over and encase areas and measure car movements, whether or not to invest in real estate, right? Or like retail real estate. And I thought it was an interesting question to give them an information advantage. That's going to evolve over time, right? I understand that. But it seems like that is an information advantage that could be taken advantage of. What are your thoughts about that?
I'm going to give you a reciprocal story, and then I'd be glad to try to answer if I'm not sufficient. I am working with a small investment management firm in New York that has, I think, designed a very interesting system. They have 7 analysts who are in their mid-30s to mid-40s who have made enough money so they've put their money in the pot that they all are managing. They're led by a man who has made a very substantial success and his money entirely in the pot, and they are taking a small number of clients. One of their lines of work is retail. They are the only organization I know that calls a different group of 30 different retail outlets every month to get 7 questions answered with regard to inventories in those outlets. They know more about that company's inventory realities at retail than the management of the company knows, because they've tested it out. That's the degree at which skill levels are going. We've all heard about drones and satellites checking to see how many automobiles are in various parking lots. That's sort of standard stuff now. The degree of specificity of over-the-top information gathering is simply astonishing. And that extraordinarily gifted firm also has made the sensible view they're not going to do anything with the 1,000 largest companies, which, of course, as we all know, is where almost all of us have almost all of our money invested, whether we like it or not. So they stay away from all the big ones. They're looking for small companies that nobody else is following. If they knew that there were 2 analysts on Wall Street following them, they'd stop. It's one of their checks. And for all the work that they put into it, and boy, are they price sensitive and marvelous people and gifted, they're just barely lagging behind the market average. I think that's tremendously compelling information. I think it's compelling information when Warren Buffett says, for my wife, I would like her to index. He's the best investor any of us know of or will ever meet. I have the privilege of having a friendship with Warren, goes back a long, long way. And when I was teaching a course on business ethics, I thought, what a terrific thrill this would be. I had the head of insider trading litigation at Davis Polk come for one class. I had the consumer reports head for a class on credit card manipulation and things like that. Now, what if I could get Warren to come? That would just be over the top wonderful. So I invited him to come to Yale and sit in with the students. He said, Charlie, I can't do that, but I'll tell you what I will do. If you bring the students out to Omaha, I'll spend 2 hours with you. Done deal? Not yet. Got to find out how we cover the cost, because a lot of the students at Yale, as you probably know, about half of them are on scholarship. So I checked in with the family that sponsors this particular course, and they said, we'd be thrilled. We'll pay for all the students to go, we'll pay for the rooms, and we'll pay for their meals. So we went out free of charge. 2 hours with Warren Buffett. What a thrilling experience. I asked the students, do me a favor. Let's have a competition for who's got the best question to ask the smartest person in any room we're going to go to in the rest of our lives. Because that is how good Warren is at this sort of stuff. So we had a really interesting competition. It was, you have to write out the question, and you have to have 2 follow-up questions, and then we as a class of 27 will decide which are the questions in which order. We only got to the 4th question because Warren gave such complete answers to every question was put up. Pros, cons, complexities, what to think about the past, how to think about the future. When he says, I'd like my wife to invest in index funds, I don't need to know a hell of a lot more. When my friend David Swenson, who's the chief investment officer of Yale, has probably got the best record anybody in institutional investing has ever had, said, indexing is the only sensible way for almost everybody. And then if you wanted to ask a rude and a blunt question, well, what are you doing with your own money? My family and I are indexers, with one exception. Back in the early 1970s, I lucked into Berkshire Hathaway, and that's close enough to an index fund, and I don't want to meet Warren someday and have him say, Charlie, I hear you're sold out on my investing. No, I'm not going to do that. So I've left it for old time's sake. Other than that, index.
Commissioner Torbert, thank you.
My turn, Charlie.
Great.
One of the things that you mentioned was about the back office operations of the 2 systems. So if I understood that correctly, your thinking would be maybe consolidate back office, but yet have your 2 investment teams.
Yeah.
Am I thinking that way?
I'm comfortable if you said we would be uncomfortable having to integrate the 2 investment decision-making units. But I'll bet a lot of other parts can be integrated and a reasonable cost saving, but an upgrade in terms of the capability set that you would have to work with. Personally, I would integrate the investing, but that's a personal thing, and I don't know anywhere near enough to think my opinion has any throw weight here.
Another question is, in the business of investments, you see a lot of volatility. Great example is the past week. By the way, the market seems to be doing really good today. And part of the reason for the dramatic change up and down is because of all the indexing. I mean, they go in mass numbers and they pull out in mass numbers.
Sorry, we're going to disagree on this, so I'll just pre-warn you. We
Okay.
disagree.
Well, your quick thoughts on that.
You know, I happen to have gotten interested in indexing back in the early 1970s. And in the mid-1970s, I did my PhD dissertation on why corporate pension funds, because that's where I had data access, clearly, given the criteria they say, we want reasonable fees, we want regular returns, we want reliability, they would seriously be a wonderful opportunity for them to use indexing. So that's surely the way they're going to go. And item by item by item, I proved it wasn't true. They didn't care about the fees. They didn't care about volatility. They didn't care about diversification, and they certainly didn't care about indexing. So as time has gone by, it's been really quite pleasing for me to see, well, I may have been wrong when I turned in my dissertation and had to defend it before the faculty, but it's coming right, and it's coming right, and coming right, and then the data that's being collected today, there'd be a wide acceptance that indexing is a very sensible and realistic way to go. So there's a little bit of, well, it's working out so far. One of the questions people have about indexing is, isn't it true that index funds are banal and just have to do whatever the index does? And isn't there enough money following a banal process that's going to slosh into the market and be highly predictable? Besides, we know exactly what it's going to do, and if I know what my competitor is going to do, that makes it easier for me to do something that is different. And none of those things appear, by looking at the data hard, appear to hold up. The one dimension that I'd particularly put focus on is there's got to be an impact on trading. Yes, but if you were an index fund manager, you would look at that as a problem that you need to deal with. And sure enough, the major index fund managers have figured out ways that they can lead and lag on indexing changes in the index. And they're able to use derivatives a lot for that purpose so that they're basically invisible and also no waves being created. And they say to you, we hear this and we hear this and we hear this, but we can't find it in our own operations. We don't see any difficulty. And then they sort of laugh but you should see what the active managers are struggling with. It must be driving them crazy. But we've got problems that we've identified, and we've figured out ways to manage those problems so they honestly just no problems. And they don't, we're just talking candidly together, just as you and I are, Mike.
Oh, I'm not saying I disagree with you. I'm just asking the question.
Yeah. Well, thank you.
Two quick comments. Back in '84, when I was a broker, trying to buy Pennsylvania municipal bonds for my clients, and hearing that I couldn't get any because Vanguard was buying them all, they'd almost take down the whole, debt group. And then years later, when I was a portfolio manager with PNC that owned 80% of BlackRock at the time, I was in New York City on the bond trading floor of BlackRock, and it was as big as the cafeteria, with people in Bloombergs and yelling to each other, buying bonds all over the world. And I thought, well, no wonder. That's probably the way to go in the future. Obviously, it was. I'm not against indexing at all. As a matter of fact, I manage my own portfolio, which is index funds and some good dividend-producing stocks. But I see that as a value added for sure when it comes to passive versus active. But I think there's room for both, and especially when it comes to private equity, because you can't really do indexing on a private equity.
You agree on private equity.
But you got to really be careful with private equity and really do a lot of study and research on that. Thank you very much for your.
Thank you. Thanks for the hospitality last evening too. That was very nice.
Okay, that.
I'm sorry that Dr. Ellis
Sorry,
is
I'm
looking
sorry.
at me, waiting for a question. Did you go to Roxbury Latin?
I did not. I went to Elbridge Gerry School, and then I went to the junior high school of Marblehead, Massachusetts, and then I went to Phillips Exeter Academy. And
I'm just checking.
I have to tell you, if I could have gone, if I'd known about Roxbury Latin, or better, if my parents had known about Roxbury Latin, I suspect that's where I would have been sent, if I could get in.
I got you. Thank you very much, Doctor.
Okay, Dr. Ellis, thank you very much. We appreciate you very much being here today. And I just want to thank, that concludes our testimony. I just want to thank the entire staff, the joint state government, the House staff, the Treasurer's staff, everyone that's been involved in the process so far. I want to thank the commissioners. We certainly have got a lot of information to consolidate and get into a report that we will deliver to the administration and the General Assembly. I just want to applaud all of the testifiers. As I have mentioned on a number of occasions, we have a lot of work to do, and I think that we can do outstanding work. And the Commonwealth of Pennsylvania has an opportunity, only an opportunity, to implement some of the recommendation that we've heard from the testifiers and from the document that we will put together. So, with that said, our next official meeting will be December 12th at a location to be determined here in the Capitol. At that point in time, we expect to have a final product that we will vote upon. As I mentioned at the beginning of the meeting, any additional comments or amendments, addendums, additions, or changes to the document that we handed out today should go through joint state government, and that will bring our hearing today to a close. Thank you.
Thank you, Mr. Chairman.